You've been lied by hundreds of trading gurus out there that you have to understand the price action to become a profitable trader. You have to read the market structure, do the top-down analysis, and look for the perfect levels to enter. But what if I told you that all of that is complete bullshit? What if instead of being an endless grind where you feel like you're constantly beating your head against the brick wall, you can build a dream strategy where you are not only trading without complex technical analysis, but it also lets you trade without second guessing every trade you take. And most importantly, that can be done spending just 10 to 15 minutes a day, so do you actually have time to do the things that you love to do that actually matters in life. But how the hell do I know that all of that is possible? About 4 years ago, I've built a complete rule-based trading strategy that gave me a mechanical edge over the market. Using that secret weapon, I was able to become multiple six-figure funded trader, allowing me to leave my 9-to-5 job, reinvesting my trading profits to gain a financial freedom and build the life I've dreamed about. Along that way, I've helped hundreds of other traders to become consistently profitable by gaining a mechanical edge over the markets inside of our OP investing mentorship program. This is the first episode of the 4-part mini-series where I will take you through the exact blueprint that will help you to master a mechanical edge over the markets to scale your trading to 6 or even 7 figures in the next 30 days without guessing your trades or being glued to the charts. About 5 years ago, I was just a kid working at a corporate job at one of the big 4 audit firms. I always had a dream of changing my life through trading, but back then funding firms were not popular. So after getting my college degree in economics with finance, I took the 9-to-5 job to fuel my dream with more cash. At that time, smart money concepts, trading like banks, Wyckoff theory, all of that was booming. My main goal was to build a trading strategy that removed the guesswork from my trading, and most importantly, I wanted a strategy that won't require much time so I could actually spend it on the things I loved. Because back then, I barely had any free time. My job drained all of my attention and energy. I was stuck working with numbers and tons of data every single day. Deep inside, I felt miserable, knowing how much work I was putting in and how little my time was actually worth. After spending months as trading SMC, I came to a realization something had to be changed. I was facing a number of problems, and if you're in the same spot I was in 5 years ago, you will probably relate to this. First of all, it was overcomplicated and filled with subjectivity. There were dozens of ways to read the market structure, dozens of order blocks, fair value gaps, all of them technically fitting the rules of the strategy. But the irony, I had to somehow choose the one to place my trade. And every time I took a loss, I would journal it and take it to my mentor. And I'd always get the same answer. I wasn't experienced enough. If I practiced more, I would supposedly train my ability to find the perfect levels to enter. It was an absurd. It felt like I was being told to train my gut feeling, which is crazy because I knew I couldn't rely on gut feeling if I wanted to be a consistently profitable trader in the long run. That's when I started my journey to find a mechanical edge over the markets. I realized that if I wanted to become consistently profitable without guessing, I had to develop a simple rule-based trading plan, one so clear that even my grandma could follow it. So where did I start? After analyzing all of the problems with my current strategy, I decided to build a new system around the 3 core values. 1. Trading simple patterns. 2. Spending no more than 15 minutes per day. 3. Trading without bias. After months of testing, it felt like nothing was working. But as I dug deeper, journaled everything and reviewed years of data, things finally started to click. I developed a day trading strategy based on trading simple patterns around the key trading sessions, and very soon I noticed something different. I was no longer forcing my trades. Instead, I let the market show me where the flow was going. I stopped having the bias. I started sleeping better at night. I was more present when spending time with friends and family. Maybe that was because of the magnesium I was taking, but I think it was because of the system I built that finally reduced the uncertainty in my trading. I had a clear routine, just a few minutes at the start of the London and New York sessions, and I was literally free for the rest of the day. I steadily grew my account, and during the boom of prop firms, became a multiple six-figure trader. I left my job, reinvested my profits, and built true financial freedom, the life I had always dreamed of. But this wasn't just for me. Since 2022, I've personally mentored over 300 traders just like you, traders who transformed their lives by using mechanical rule-based patterns. That's why I highly suggest you to watch all 4 videos in the series I have prepared for you. But before we dive into more technical part, you first need to build a strong conviction that trading a fully mechanical, rule-based, bias-free strategy is the only way to become a consistently profitable trader over the long run. If you don't do that, this is going to be just another brain rot video that you watch today but never take action on. So stick till the end of this video. The biggest problem I see in trading space is inconsistent results. I get messages like, "Hey bro, I've been trading for ages. I literally know everything about trading. I've learned all the strategies out there, but I'm still struggling to make consistent profits." And if you don't understand why this happens to people, this is exactly what you will end up in the future. The reason is simple. People are going against the nature of trading. Trading is pure probability game, and price movements in the markets are random. But what do most traders do? They try to read markets to predict where the price will go. They trade based on their bias, which they've built analyzing the market structure, looking at liquidity behind trend lines, equal highs, or other some BS series. They have a millions of reasons in their head why the price must go up or down. If I tried to list all of them, we would be here for the whole day. But here's the problem. Trying to predict the market actually leads to the trading based on their feelings, not on actionable, repeatable, rule-based system. And the consequences of trading without a structured plan, they are devastating. Without a structured system, every trade feels like a gamble. One day you win big, the next day you give it all back. You can't trust your own decisions because they are based on emotions, not a proven process. So let me break down my own experience trading the smart money concepts, and I bet you have faced some of these problems. First of all, as you know, SMC is mainly based on reading the market structure, doing the top-down analysis and getting the buys from that. It gives you the full sense of control, like you know where the price is headed. But in reality, sometimes you're right, sometimes you're wrong. It's a pure probability game. Instead of accepting the loss, you start questioning your skills, asking yourself what mistake you've made. Every time you take a loss, your self-confidence takes a hit. Then you start adopting every trade you take, you end up miserable and depressed. But that's not even when the problems end. Now, don't get me wrong, I'm not against higher time frame analysis. When used the right way, knowing you're playing with the probabilities, it can actually be a good thing. Trading in the direction of the trend increases your win rate by 60%. And here's where traders mess up. They start mixing multiple time frames when doing the top-down analysis. For those who don't know, this is when you identify the market direction on the higher time frame, mark out the key levels on the higher time frame, wait for the price to approach these levels, jump to a lower time frame, analyze the market structure, and look for entries. Sounds genius, right? In reality, it's nearly possible to trade it. Let me explain you why. I've tested years of data on this method, and there are 2 major problems. Problem number 1, no confirmations on the low time frame. Over 50% of the time, price retests those higher time frame levels but never gives a confirmation on the low time frame. What does it mean? It means that there's no structure to trade it on the low time frame, just a strong impulse with no setup. So basically you can't even enter the trade. Problem number 2, the levels you choose might never get hit. This is even a bigger issue and leads to multiple bad consequences. When you're doing a higher time frame analysis, you might choose a key level that's super far away from the current price. And here's the risk. That level will never get mitigated. Price might never pull back deep enough to test it. So you wait for days only to watch price reverses from a level that you didn't see. And here's when it gets even worse. Since you take a lower time frame entries, you consider yourself a day trader or even a scalper. You want to trade every day, but in reality, you have to wait for days just to get one trade. That creates inconsistency in your trading. You feel like you need to take trades, but there are no setups. That leads to constant feeling of FOMO. And if you keep trading like that for months, your nervous system will be wrecked. So if you're tired of this cycle and want to finally break free from that, keep watching. And the biggest problem with the top-down analysis, the one I struggled for years, and I bet you do too, is this. You know where the price will go, but you never know when. Back then, I used to do top-down analysis, mark up my key levels and wait. But most of the times, price would retest those levels when I was not even at my charts. I was sleeping, eating, working out, doing literally anything except watching the charts. Imagine this, you've been waiting for the setup for days or even weeks, and when it finally happens, you miss it. This is kind of like frustration. It's a next level. The FOMO was unbearable. There were days where I completely lost control over myself, either because I missed the trade, price reversed without giving me entry on the low time frame, or price never even mitigated my level in the first place. And here's the final nail in the coffin of the price action trading, or any strategy that relies on the higher time frame analysis and low time frame entries. You are going to have an extremely low win rate. It's not humanly possible to catch the perfect reversal at the first hit. People who flex with insane risk-reward ratios, most of them have a win rate which is below 50%, which is below, 5%. And trust me, such a low win rate will destroy your psychology. You'll start doubting every trade you take, you'll start hesitating, overanalyzing, and second-guessing yourself. And ultimately, if you keep trading a non-mechanical strategy, one of the two things will happen. You will eventually give up trading altogether after wasting tons of money trying to figure it out, like on yourself. And secondly, which is even worse, you will not give up. You'll just keep burning the hard-earned money, trapped in the cycle of overtrading, revenge trading, and emotional gambling. At that point, trading won't be a business for you. It will be gambling addiction, discussed as a trading. You'll become just another guy chasing adrenaline, winning some day and losing even more the other days. Now, ask yourself honestly, did you come here for entertainment? Or did you come here to actually make money with trading and change your life and the lives of those who are around you for good? Before we dive into the next lesson, let's quickly talk about the mechanical edge or the markets and why trading with one is a game changer. The main goal of mechanical edge is simple: to remove the guesswork from trading so you can win trades without overcomplicating your analysis or being glued to the charts all day long. Why do you need a mechanical strategy? Have you ever learned a strategy from someone else, but when you tried to use it, you failed miserably? That's because most strategies are not fully rule-based. You can't simply copy someone else's experience. That's why your favorite guru keeps telling you, spend more time in front of the charts and backtest until the strategy finally clicks. And maybe that will work for some people, but here's the reality: 95% of traders fail. So if you want to increase your chances of actually winning this game, you need a strategy that you can replicate and execute consistently, not just some vague, discretionary system that relies on your intuition. The benefits of mechanical edge. First is the clarity. You will know exactly what setups to trade and when. Most traders overtrade not because of the bad psychology, but because they don't even know how many trades they should be taking. Here's the truth. Scalpers will get 1 to 2 trades per session. Day traders will get 1 to 2 trades per day. Swing traders will get 1 to 2 trades per week. But when you trade a non-mechanical strategy, you don't follow the clear setups. You just try to read the markets and predict the future price action. With a mechanical strategy, you trade only specific setups that occur under the clear conditions. So with this one, you can actually differentiate were there your setup or there was no your setup. For example, in OP method number 1, we mark up the first 4 hours of the Tokyo session, trade the breakout during the London and New York sessions. There is only one breakout per one direction, like one breakout to the upside, one breakout to the downside. If price breaks out, retest the Asian range and gives an entry. I know this is my trade for the day. If I miss it, that's fine. I know that there won't be another setup later. Then there can't be another breakout and retest of the Asian range because it's already over. This removes the FOMO and stops you from taking random trades out of the desperation. 2. No more self-blame. When you trade a non-mechanical strategy, every time you lose, you start questioning yourself. Did I make a mistake? Should I have entered earlier? Did I read the markets wrong? With the mechanical strategy, those doubts disappear. Let's say we're using the OP method number 1. We mark up the Asian range, we see a strong breakout, price retest during the trading sessions, we take the trade. If it loses, no problem. We did everything right. That's just a part of the game. 3. You know exactly when to trade. Time matters. A mechanical edge includes a time-based element, like how the first 4 hours of the Tokyo sessions are always the same. With this approach, you will know exactly when setups will form and when to stay out. In the long run, you're going to have these benefits. Less stress. You accept the uncertain nature of trading. More confidence. You stop second-guessing every decision. Consistent actions. And as you know, consistent actions to lead consistent results. With consistency, you can grow your personal trading account, pass funding challenges easily, make consistent profits to reinvest into passive income streams. And this is when trading changes your life. This is when the strategy that you have mastered funds the dream life that you actually want. Where you become a multi-six-figure trader, stack cash, quit your job that you hate and live the life on your own terms. Trading from anywhere, traveling the world, doing whatever you want. This lesson was the stepping stone to understand what it takes to become a consistently profitable trader. Now in the next video, I'm going to break down 3 core entry models that will change the way you trade forever. The biggest mistake that unprofitable traders keep doing throughout years is not understanding the core logic of the markets. Not knowing how does the markets operate is costing you thousands of dollars, dozens of funding challenges failed, and hundreds of strategies changed. But in reality, if you stick till the end of this video, no matter what strategy you trade, no matter what type of trader you are, a day trader, swing trader, or even a scalper, you will have the breakthrough in trading, that exact aha moment that you were looking for. Today, we're going to cover 2 core market conditions that dictates what you have to trade, and we are going to cover 3 more entry models that you must incorporate into your trading plan that will help you to adopt and trade all the market conditions. But this is not all, folks. At the end of this video, I will let you know the exact way of how you can trade any strategy and make it a mechanical and rule-based. Hello folks, welcome back to OP Investing. My name is Islam. This is a second episode of the 4-part mini-series where I will take you through the exact blueprint that will help you to master a mechanical edge over the markets to scale your trading to 6 or even 7 figures in the next 30 days. without guessing your trades or being glued to the charts. If you haven't checked the first video, I would highly suggest you to watch that first and get a full picture of what we're talking about here. Without wasting your time, let's get started. Let's first start with the basics of trading. Understanding this is important, yet most traders don't pay attention to it. There are two core stages in the markets. Let's quickly break them down, how you can effectively identify these stages, and then I will explain why it is important and how we can use it. Markets are either trending up or down, or the price is moving sideways. Let me quickly explain how we actually know when the price is trending and ranging. This is going to be a quick lesson on how to read the market structure. When the price is creating highs that are higher than the previous ones and lows that are higher than the previous lows, that means that price is in an uptrend. When the price is creating lows that are lower than the previous lows and the highs that are lower than the previous ones, that means we are in a downtrend. All of that should happen consistently. The price keeps making new highs and lows in one direction. Then we can tell that the price is either trending up or down. Now let's break some real charts. Over here you can see a clear downtrend to the downside. This is a EUR/USD on the daily time frame, and you can see here we do have the lows that are lower than the previous lows, and we do have the highs that are lower than the previous highs. That means that we are in a downtrend. The biggest criteria of the trend is that the price is making consistent actions, consistent impulses in one direction, whether that's going to be up or down. Over here you can see it's the price going from the downtrend over here going into the uptrend. It starts making consistent highs that are higher than the previous highs, and it starts making consistent lows that are higher than the previous lows. Now that you understand what a trending market is, it is crucial to understand what is a rangy market is. A rangy market is literally the opposite of the trendy market. If I had to break it down in one sentence, price is not making consistent highs or lows in one direction. The price might make a higher high only to make a lower low right after that. Sometimes price makes a new highs and lows and then just sweeps the previous levels and then reverses. Now let's look at how this plays out in the real market conditions. Over here you can see a clear rangy market conditions on the EUR/USD. The price is just going sideways, making high, it's making low, it's making higher highs, it's making higher low, higher high, but only after that the price is just crushing to the downside, making the lower low, and after that it's going to the upside, making a lower high and then higher low, and then we are making another higher high. So it's basically going in a sideways. We don't have any consistency to the upside or to the downside. Of course, if we zoom in into the lower time frames, we will be having its own like lower time frame trends, but on the daily time frame we can see a clear range bound market conditions. This is how it looks on the real market conditions. Now that's how we identify the markets using the market structure. But here's another way to do that, using the 200 EMA. This method is widely used by the institutions and banks. The 200 EMA is literally the key to identifying the long-term trends in the markets. It's simple. When the price is above 200 EMA and the EMA itself is sloping to the upward, we are in an uptrend. When the price is below the 200 EMA and the EMA itself is sloping to the downward, we are in a downtrend. Personally, I don't use it to identify the trends, but rather I use this to identify the absence of the trend. And for that, it works perfectly fine. When the 200 EMA goes flat, that means that we are in a true rangy market conditions. So now we know how to identify both trendy and the rangy market conditions using market structure and the moving averages. But why is this so important? Most of the traders fail or go through the losing streaks not because they have a bad strategy, but because they use the wrong strategy for the current market stage. Think about it. Can you use the trend following strategy in the rangy markets? Or can you use the range trading strategy in the trendy markets? The answer is no. For each market conditions, you must have a strategy that fits it. Based on what we have covered so far, you must have at least 2 strategies. One for the trendy market conditions and one for the rangy market conditions. Alright, now let's talk about the 3 core entry models that will literally catch all the possible market conditions. The first one is the breakout model. But before we dive in, think about this. As you remember, we have 2 market conditions, when the price is trending and when the price is ranging. After the trend, there is always going to be a range. After the range, there is always going to be a trend. A range cannot last forever. After some accumulation, the price will break out and start the new trend. And the trend can't last forever either. Eventually, it will exhaust and transition into the rangy market conditions. So the logic behind the breakout model is that we catch the trend even before it is born. I bet you've been in a situation when you see a clear trend, you try to jump in and the price immediately reverses against you. Let me tell you something. If you can see a clear trend, it is already too late. Too late to trade it. This is a very famous 5-wave pattern that was invented by the Ralph Elliott. He said, overall the trend in the markets consists of the 5 waves. 3 waves in the direction of the trend and 2 into the opposite direction. After price completes these waves, there comes a short-term correction or the sideways movement. But we are not here to learn about the Elliott wave analysis. I'm giving this example to explain you when you see price having a consistent trend, the end of the trend might be somewhere near. So the best way to identify the trend, actually trade it, it would be when it's about to start. 90% of the traders fail. And if you want to be among the 10% of winner traders who actually win and move the markets, you need to spot potential trends before they even happen. That's why the breakout model, instead of looking for the trends, we focus on spotting the rangy markets, because that's where the next big movement is going to start. So literally you can use this model in any time frame, and adding this model into your trading routine will dramatically improve your win rate. Now let's move to the second universal model, trading the reversal. This is basically about trading the supply and demand zones. This method works best in the trendy market conditions. As you know, when we are riding a trend, you have to wait for the price to pull back and then catch the reversal in the direction of the trends from the key supply and demand zones. But let me share a little secret about the supply and demand zones that will change everything for you. You need to stop looking for the random swing highs and swing lows and start focusing on the supply and demand levels with a time reference. Here's how it's done. If you're a day trader or scalper, you should only look for the supply and demand levels inside of the previous day candle. Just get the previous day candle and look for the supply and demand zones only inside of the previous day candle. The price action happened during the previous day candle is all that matters, nothing more. Let's say you're a swing trader. You need to look for supply and demand levels inside of the previous week's candle. That's where you will find the key levels with the power to move the price for the upcoming week. All the rest levels are just some fake imaginary levels. Probably they will never get mitigated at the first place, and secondly, yeah, just forget about them. Following this rule, you don't have to guess which supply and demand levels you have to choose among millions of levels on the charts. Let's say you're a day trader and you look for supply and demand levels inside of the previous day candle. There are going to be only a handful of levels that you can choose. So this will reduce the level of stress that comes from the abundance of choices. There's going to be just 2 or 3 maybe levels inside of the previous day candle. Furthermore, you will stop choosing the levels that are super far away from the current price, so you don't waste your time for the levels that are never going to be mitigated. Once you start following this, you will see a tremendous change in your trading, and sometimes you can even trade range-bound market conditions when the price reverses from the established highs and the lows. Now, the last pattern that you have to incorporate into your trading plan is liquidity grab model. This is where the price sweeps previous highs and lows and makes the fake breakouts before reversing into the opposite direction. Let's break down how liquidity grabs and fake outs look like. A liquidity grab happens when the price wicks above or below of the given high or low. A fake out occurs when the price breaks out with a strong bullish or bearish candle, but the very next candle reverses back inside of the level. Now, you probably already know about the liquidity grabs and fake outs, and that you should trade them during the rangy markets when the price is sweeping highs and lows without clearly trending in one direction. But let me tell you something, using random highs and lows will not work if you want to catch perfect liquidity grabs. To do it perfectly, you need to know exactly where liquidity is resting. In just a minute, I will show you the exact mechanical and effective way to identify liquidity zones. But first, let's talk about where not to look for liquidity. Forget about the equal highs, trend lines, or other BS levels. They are not mechanical. The levels you see will be different from what someone else sees. One trader might mark equal highs in one place, while another will draw trend lines differently. It is completely subjective. Syncing up two random dots on the charts, it is insanity. Your liquidity levels should be so mechanical that even your grandma could find them. So what's a real way of identifying the key liquidity levels? Looking for the highs and the lows that are tied to the time. Previous day high or low, previous week high or low, previous month's high or low. These are the most mechanical, universal, and the strongest liquidity levels. They will be the same for you, for me, and for anyone else in the markets because they are absolute. We're not just taking them out of our mind. We're not just spotting them, looking for them. They're absolute. Using these liquidity levels, you will stop guessing where the real liquidity is resting. Your trading process will require less mental resources, so there will be less chance that you will start taking impulsive trades. To sum it up, if you're trading the markets every day using the breakout, reversal, and liquidity grab models, you will be able to cover almost 90% of the price action. You will be able to trade both trending and ranging market conditions. You will be able to catch reversal as well as the start of the new trends. Now, I would say probably you're already using these models, but in the wrong way. Maybe you're focused only on one of them, when in reality you need to master all of them to get the best results. Maybe you don't have a complete trading plan and systems around these entry models, because remember, these are just tools. Without a proper plan, they will not make you any dime. Like, you will not be a profitable trader. You need a system. And most importantly, I bet you're using them in a non-mechanical way, spotting random supply and demand levels, drawing equal highs and or trend lines for liquidity, or trying to catch random breakouts. That won't make you a consistently profitable trader. We have already discussed some key elements to help you trade these models in a more mechanical way. Personally, I have developed 4 patterns based on these 3 core entry models that occur over and over again during the London and New York sessions. These are called OP investing methods. And because they are 100% mechanical, even your grandma could trade them. In the next video, we are going to break them down one by one with actionable steps. See you there. Are you tired of endlessly switching strategies, looking for the one that will actually work for you? All of the strategies you choose promise you a lot, but when you start actually following them, the reality comes out that all of them are filled with subjectivity. There are no clear rules to follow, and you always feel lost and frustrated while using them. Let me tell you something, if you have failed with trading so far, this is not your fault. You can't simply become a profitable trader by copying a strategy that is not mechanical, that is not rule-based. What if I told you that trading can become effortless when you are not only second-guessing your trades anymore, but also gain a true confidence while executing your trades? Most importantly, all of that can help you to become a consistently profitable trader, scaling your trading to 6 figures while spending just a couple of minutes a day. Sounds too good to be true, right? But this is exactly what we are going to cover today with you. You will learn to trade 4 simple, rule-based patterns that will help you to adapt to the markets in the real time and trade all the market conditions. Once you master them, everything will click for you. Hey folks, welcome back to OP Investing. My name is Islam. This is the 3rd episode of 4-part mini-series where I will take you through the exact blueprint that will help you to master a mechanical edge or the markets to scale your trading to 6 or even 7 figures in the next 30 days without guessing your trades or being glued to the charts. If you haven't checked the first 2 videos, I would highly suggest you to watch them first to get a full picture of what we are talking about here. Without wasting more time, let's get started. Now let me share a story with you. When I first switched from trading with indicators, it was the boom of the smart money concepts, and it made the sense to me at that time. But as I dived deeper, a couple of problems came out. I knew where the price would go, but I never knew when. Most of the times, I missed the price approaching to my key levels because I was either sleeping, eating, studying, or I was busy with something else, not checking the charts. Did you have the similar situation when you can spot the pattern only after it happened? That's literally because you were not in front of the charts while it was happening. I felt frustrated because I missed the trades, and after missing the trade that I was waiting for days, I was furious. I was like, damn, I had to find the trades to trade them. The FOMO was through the roof, leading to the violations of my trading rules and more losses. Can you imagine this? It couldn't go on like this. I needed to tweak the strategy so I would know exactly when to trade and when not to trade. I need a clear rule for each market conditions because relying on one entry method would not work in different market conditions. Like trend following will not work during the range, and strategy that was created to trade the range will not work during the trend. I spent months forward testing and back testing, years of data, looking for the patterns in the price action around the London and the New York opening times. At first, it felt like there was nothing in common, but over time, things started to become more and more clear. Price followed one of the 3 distinct patterns. It would either break out and retest and continue in the direction of the Asian range, or retest the key level and then reverse in the opposite direction, or make the liquidity grab around the key levels and reverse. Does it make sense so far? So folks, probably you're already using these models but using them in the wrong way. Fortunately for you, we've got the solution for that. Based on these 3 core entry models, I came up with 4 patterns. 4 patterns that repeat themselves over and over again during the key trading sessions. These patterns are traded around the origin point that we mark up during the Tokyo session. To mark up the origin point, you just need to mark up the first 4 hours maximum and the minimum point during the Tokyo session. All of our trades are traded on the 15-minute time frame. Let's get started. OP investing method number 1. This method focuses on trading the breakout and continuation from our origin point. Just imagine being always ready to catch the trend reversals or the early trends after the rangy days. With this method, we find the strong breakout from our origin point and enter on the retest of the key levels inside of the origin point. And as you remember, the origin point is the first 4 hours of the Tokyo sessions where we mark up the high and the low of the price action. Whatever happened during those 4 hours, we mark up the high and the low, and this is our origin point. OP method number 2. With this method, you are able to identify the hidden intraday key levels. This method focuses on trading the reversal from those key levels. Just look at the examples. The price was trending the previous day and made the retracement the next day into the previous day candle. This is where we caught the reversal from the key level. Sometimes we can even trade the price reversals during the rangy market conditions, as you can see in this example. OP method number 3. With this method, you focus on catching the price reversal around the borders of our origin point. These levels hold a significant amount of liquidity beyond them. This method is crucial when price is entering an indecisive position. OP method number 4. The lost pattern focuses on trading the manipulation. We trade the liquidity grabs around the key daily levels. Most of the times, the previous day high and the low act as the reversal points. Imagine being able to catch all the moves during the ranging days, spot the early trend reversals. This is exactly what this method will do for you. By combining all 4 methods, we can cover all possible market conditions and all possible entry models. That's really awesome, right? Let's quickly backtest the EU together with these concepts that you have learned right now. Okay folks, this is a EURUSD on the 15-minute time frame, and I just want to cover a couple of examples with you over here just to show you how does the OP investing methods work in the real life. This action happens on the 15-minute time frame. All the trades are taken on the 15-minute time frame. So let's start with this day. As you can see over here, the previous day candle was bearish, and over here we do have our Asian range. This is our high, this is our low, and over here you can see that the price is breaking to the downside, and this vertical gray stripes actually represents, this one represents the first 4 hours of the Tokyo session, this gray stripe. This green stripes represents the first 2 hours of the London, and this one represents the first 2 hours of the New York session. And all of our trades actually happened, like all of our entries actually happened during the first 2 hours of the either London or the New York session. Over here we do have the breakout to the downside, and as you can see over here, the price is retracing to the upside in to retest our Asian range exactly during the London session. And over here we can have our entry at the 60%, place our stop loss above 80%, and bum, 8R trade. But most of the times we just aim for 5R, because with our methods, with our strategy, you will be aiming for 5R, which is most of the times is guaranteed. So let's move to the next day. Over here you can see our Asian range here, and this is the low of our Asian range. And as you can see over here, the previous day candle is kind of like indecisive. We are entering into more kind of like range bound market conditions. And over here, the price is breaking to the upside. It is going up. And let's say we could have looked for OP method number 2 over here. This would have been some sort of like the break even or even a lost trade. And later on during the New York sessions, exactly, the price is sweeping this high over here and reversing to the downside. If you go to a low time frame, you will see the market structure shift where you can enter the OP method number 4. Actually, over here you can see that this is our low, and over here with this candle the price is breaking below this low, and this week over here is retesting and giving us entry on the low time frame. So this is OP method number 4 trade the next day, and this has happened exactly during the New York session. So let's move to the next day. The price is breaking to the upside but never coming back to retest during the London session during the first 2 hours, but later on between the London and New York, it's coming down and retesting our Asian range. But this happens like very rarely, 2-3 times out of 10, when the price comes and gives us entry during the no trading time. But over here you can see the price gave us entry at the 80% and went to the upside. You might ask yourself a question like why we are entering at the 80%. Actually, this is a little secret for you, but I will just with you here. Sometimes we enter at the 60%, sometimes at the 80%. And the answer here is that we enter at both levels. We place our trades at the 60%, at the 70%, at the 80%. So we are basically breaking down our trades into 3. So if you even lose your trade with 60%, you will at least win the one with 80%. That's why I don't get surprised when I'm using like the different zones for entry. Okay, the next one over here. The previous day candle is bullish. Over here you can see our Asian range. This is our AR. The price is breaking to the downside over here, and we are having the beautiful retest during the London session, and it is retesting exactly the break block. With OP method number 1, we are basically entering into with 2 levels. The first one is with FIB levels, the second one with the break blocks. We do have more kind of like rules how to enter with each one, when to look for FIB levels, when to look for break blocks, but I will not be going too much in details in this video, guys. So basically the price is giving us OP method number 1 to the downside over here, and later on it is even giving us the OP method number 4 trade, sweeping the previous day low right over here and reversing to the upside. Again, all the entries are on the low time frame, sort of like the price is sweeping down and creating the new order flow. And by the way, we sometimes enter our trades with the order flow of the markets. The next day, Asian range, you can see the Asian range over here, we are having the breakout to the downside because there are some market conditions that we don't trade, and this is one of them. When we do have like a huge candles at the previous day candle, we tend to avoid such days. We will be just going to the next day. Over here you can see this is our Asian range, this is our Asian high, this is our Asian low, and you can see that the price is breaking to the downside. The previous day candle low is pretty far away. That's why we will be using that for OP method number 2 trade. And over here you can see that the price is just reversing from the previous day low and giving us some R. Yes, like it's giving us 2 and then reversing into the opposite direction. So it's basically the break-even day. Moving to the next day, we can see that the previous day candle is bearish. This is our AR, which is at the bottom of the previous day candle. The price is breaking to the upside, and exactly during the first 2 hours of the London session, it is retesting this order block right over here. We do have some rules to identify that. And this is an order block that we usually look for, and it is exactly giving us a 5-hour trade exactly during the first 2 hours of the London session. So this is how we trade over here. And after that, we do have this pretty huge gap. Like most of the times, like when we do have such gaps, I avoid trading that day. So we just go to the next day. The next day is pretty much untradeable as well, because we do have our Asian range is too pretty big. Like as you can see over here, the Asian range is 60 pips, when in reality it usually 20-30 pips that we want to see to trade the markets. This is again like one of the secrets of OP investing methods, trading the OP investing methods. And again, the next day the Asian range it's pretty tight, like compared to the previous day candle. As you can see, it's just 15 pips. Over here the price is breaking to the upside, but it's never giving us. Over here we do have the sweep. The price is breaking to the upside. I would have expected the retest, but the price is not giving us entry and just going into the direction of the breakout to the upside. So it's basically no trading day, guys. The next day we do have our Asian range right over here. The price is breaking to the downside, and it's giving us entry exactly during the first 2 hours of the London session. Over here from the 80%, it's kind of like giving us about 3R. And yeah, it's kind of like just hitting some break even probably later on. So sometimes we do have such scenarios as well when the price is not giving us 5R, but we are safe. The price hit the break even and like that. Of course, we do have some losing days as well, guys. As you can see over here, the price is breaking to the upside, and exactly during the first 2 hours, it's coming back to retest. But in this case, it is taking us out on this low. It's kind of like the price action is pretty choppy over here, and yeah, that's not the best scenario to trade the markets overall. Okay, moving to the next day, over here we do have our Asian range. The price is breaking down to the downside during the London session, and it's kind of like coming back to retest to give us entry during our no trading time. As I said, like it happens rarely, but this is something that you can trade as well, because overall we do have our Asian range, we do have the breakout, we do have the retest and continuation in the direction of the breakout. The next day, Asian range is over here. The price is breaking to the upside, it is coming back to retest our Asian range during the no trading time after the New York session. But over here, we do have actually something interesting. As you can see, the previous day candle is bearish. Over here, Asian range is at the bottom of the previous day candle, and the price is actually giving us OP method number 2 trade from the previous day high. Oh, actually, this one is a previous day high candle. This one, right? It's actually giving us OP method number 2 trade from the previous day high in the direction of the previous day candle trend. And it's kind of like, it's again like didn't give us a 5-hour trade, actually, kind of like it just missed that by a couple of pips. But overall, like if you held that over the next day, it gave that during the next day. But we don't do that. We don't usually do that. So it's probably like either the winning trade or the break-even trade based on how you have managed that trade. The next day, the price action is just getting more range-bound conditions. So at such cases, we tend to look for OP method number 4 trades. And over here, you can see a clear example of the OP method number 4 happening exactly during the first 2 hours of the London session. We're sweeping the previous day low, and then we're getting the entry on the low time frame and reversing to the upside. So let's move to the next day. Here's our Asian range over here, just drawing. I hope this is clear for you. The price is breaking to the upside, and it is giving us entry at the 60%. And this is giving us like a beautiful, let's see how much R, like, it was 8R, but we usually aim for 5R trades. So it is again beautiful. The next day is again like, it's a beautiful day. Here's our Asian high. The price is breaking to the upside, which is draw our FIB levels into, like, let's say at 80%, getting the best case scenario, because we place our trades at like 3 levels, 60, 70, 80, and it gave us like almost 10R trade, you know. It's a beautiful trade, basically. So guys, this is it. I guess I have covered about a month's worth of information over here. So I hope you've got some picture of how does the OP investing methods work in the real time. As you can see over here, the Asian range is the same for you, for me, and for anyone else. It's all rule based, it's all mechanical. You cannot trade the OP investing methods differently than us. We cannot trade the OP investing methods differently than you. All the levels are mechanical. The previous day candle high, low, they are the same for you, for me. Asian range is the same for you and me. And you cannot kind of like, you cannot basically interpret the breakout differently than us. So it's just a simple breakout and retest. Of course, this is not all. You might be asking yourself, like, how can I combine the first method, second method, third method, fourth method? Which method should I be looking for? But of course, guys, we do have more rules on all of that. So make sure to watch all of the 4 series in our 4-part mini series that I have prepared for you to get the better picture and how I can help you just to learn these methods even better. And basically, guys, most importantly, you won't be spending much time. You just open your charts at the beginning of the London and the New York sessions. You just mark up your key levels and just wait for the price to give you the entry. It's going to take you just a couple of minutes a day, so you won't be staring at charts all day long, so you can actually spend your time on what truly matters in life, on what you love to do with your close ones. So folks, transformation after using these methods were crazy. Finally, by trading the OP investing methods, I gained clarity in the markets. I had a solid trading plan and routine. Opening the charts and evaluating the current market conditions, I could determine which OP method was likely to work out today. I didn't have to spend my whole day in front of the charts to avoid missing trades. I had a specific time when most price movements occur. This was the time when I had a breakthrough, not only in my trading, but in my personal life as well. Can you imagine yourself doing that as well? I started feeling better. The level of uncertainty and stress in my life decreased. And the cool part is that it didn't just work for me. It works for all kinds of people all around the world. I have personally taught over 300 people who are successfully using these methods every single day. And now let me break a couple of questions that you might have in your head right now about the OP investing methods. If markets are unpredictable, how can a fixed strategy work? You don't need to be right all the time to be profitable. Trading is a probability game. The OP investing methods deliver an average 5-hour trades per every trade. Even with 20% win rate, you will still end up being profitable. But with 60% win rate, this strategy gives you a significant edge over the markets. Does this strategy work in all kind of market conditions? Yes. The OP investing methods is built on 3 core entry models designed to work in both trending and the ranging market conditions. It adapts to different conditions, keeping you in control. How this strategy is different from other pattern-based strategies? Okay, here's the answer. Most strategies lack clarity on when and where to apply patterns, making them subjective and inconsistent. The OP investing methods integrates a time-based element, ensuring trades are executed around the key origin point during the key sessions, eliminating the guesswork. So you know what to trade, how to trade it, and when to trade it. What if these patterns stop working? They won't. These patterns are based on fundamental market behaviors that have remained constant for decades. Backtest them yourself and you will see everything. I don't have enough experience, or I have tried and failed before. No problem. OP investing methods are beginner friendly. You only need to learn 4 simple patterns with a structured framework. By removing subjectivity and emotions, the strategy becomes easy to follow and replicate. A struggle with analysis paralysis and sticking to one strategy. This is one of the biggest problems of the traders. That's because vague rules create confusion. The OP investing methods provides a clear step-by-step plan with price plus time-based patterns around the key origin point. There is no room for doubt, just a structured, repeatable process. I don't have time to learn and trade the complex patterns. Listen, one of my first students, Luke, had a full-time job in UK Air Forces. Yet, he successfully traded the OP investing methods. Once you experience what a true mechanical strategy is, you will never look back. Do I need to be glued to the charts all day long? And the answer is no. We trade on the 15-minute time frame, checking the charts once in every 30 to 60 minutes. While a bigger screen helps with analysis, you can manage trades from your phone without complex multi-time frame analysis. You might be thinking, your job is mentally exhausting and you can't focus on trading. This is not a problem. Decision fatigue is real. After making like 50 to 100 decisions, the brain defaults to take impulsive actions. But the OP investing methods eliminate this problem. With a mechanical rule-based strategy, decision-making becomes effortless, helping you trade with confidence. We literally eliminate any decision-making with OP investing methods because all of the rules are on paper. This is all good, guys, but it's just one side of the coin. To be a consistently profitable trader, you must have a solid edge over the markets that we have covered today here. But more importantly, you must have a solid mindset. When your psychology is on place, the rest will be that easy. But the problem is that people think that psychology is about meditating, journaling, and other stuff that doesn't actually solve the problem. In the next video, we're going to address the root causes why you have the psychological problems with trading. Make sure to watch the fourth and the last video that will make sure that you will master a mechanical edge over the markets and successfully implement them in the real life. It took me 5 years to come up with these 5 rules about trading psychology, but if you give me next 10 minutes of your time and actually listen to what I say here, I will save you years and years of struggle that you will face in trading. Understanding and incorporating these psychology hacks got me from being break-even phase in my trading to the point where I was making consistent profits without efforts. If you've already have strategy which is statistically have an edge over the markets, the only thing that is standing between you and the success is your mindset. But most of the people get it wrong when it comes to trading psychology. They assume that they have to somehow train their willpower to better control themselves, but this is not how it actually done. To be a disciplined trader, you have to put yourself into the environment that makes you disciplined. You have to incorporate some trading rules that will help you to be disciplined. And this is exactly what we are going to cover in this episode. Hello folks, welcome back to OP Investing. My name is Islam. This is the last episode of the 4-part mini-series where I will take you from the exact blueprint that will help you to master a mechanical edge over the markets, to help you scale your trading to 6 or even 7 figures in the next 30 days without guessing your trades or being glued to the charts. If you haven't watched the first 3 videos, I would highly suggest you to watch them first to get a full picture of what we're talking about here. Without wasting more time, let's get started. There are 4 stages of expertise in any field you choose. First, you're incompetent and you're unconscious about your incompetence. Then, you realize your incompetence. This is when you start consuming tons of educational content, learning every strategy you can find. This stage is called conscious incompetence. Over 50% of the people are going to give up on trading at this point. After years of practice, you finally find a strategy that works for you. You start having some wins and losses, nothing massive yet. This stage is called conscious competence. Most traders spend years here. To move to the next level, they need to work on their mindset. And the next level is unconscious competence, the stage where trading feels so natural that it becomes the part of your personality. At this point, you have an abundance mindset. Your psychology is tuned in and you make in a month more than you have lost in all of the years combined. To reach the highest level of competence, you must master both psychology and your approach to the market. But here's the most traders get it wrong. You think mastering psychology means training on your mind, becoming more disciplined through mindfulness, meditation, journaling, etc. Sounds good, right? But this is the biggest scam in trading today. There's a reason you keep blowing up accounts. There's a reason why you take impulsive trades. There's a reason why you overtrade. Meditation, journaling, they only treat the symptoms, not the root causes. So today we're doing things differently. We are addressing the real root causes. Let's start with the risk management. The number 1 goal of any trader is to preserve the capital. Only after that we should think about growing it. But I won't waste your time telling you that the risk management is no more than 1% per trade. You already all of that stuff better than me. What I want to tell you is something that you have never paid attention to, something that makes you over leverage, take on unnecessary risk and blow your accounts. Most traders out there trade multiple pairs at the same time. They think that this gives them diversification. But here's the problem. All major Forex pairs are traded against one common currency. Can you guess which one? Exactly, that's a US dollar. Go to the Google and type Forex pair correlation. You will see that most pairs traded against the dollar are positively correlated. That means if Euro USD goes up, GBP USD is also likely to go up too. This also applies to the future markets. Major indices like SPY, NQ, and Dow Jones, they're all positively correlated. Just open the charts, you will see how their price action almost mirrors each other. So what's the issue here? When you trade multiple pairs at once, even if you follow the risk management, you're exposing yourself to the higher risk. If you're wrong on one trade, you're not just losing one trade. You're likely losing multiple trades at the same time, increasing your drawdown and taking a serious hit on your psychology. So what's the solution here? Set yourself a daily risk limit. Tell yourself, I will not risk more than 1% per day. That 1% risk can be divided between multiple pairs, but your total exposure stays controlled. This simple shift will protect your account and let you trade with way less stress. So let's move to the rule number 2. There's a common mistake among the traders that leads to a very low win rate. But not knowing this rule doesn't just result in a low win rate, it has severe consequences. Traders who ignore this end up dealing with constant anxiety and fear of missing out. But don't worry, in this episode we're building up your perfect mindset step by step, and this rule is one of the most important ones. First, you need to understand that aiming for a high win rate comes with a cost. I remember when I first started trading smart money concepts, back then social media was filled with the traders flexing with 20-30 hour profit trades, and I had the same goal in my head: I need to win big. But after trying to catch the perfect, most refined order block over and over again, I realized something. I would lose at least 20 times before catching that one 20-hour trade. That's when I discovered a key principle. There's the negative correlation between win rate and risk-to-reward ratio. In simple terms, the higher the reward per risk you aim for, the lower your win rate will be. And the vice versa, the higher your win rate, the lower your risk-to-reward ratio is going to be. And the vice versa, less you aim, the higher your win rate is going to be. After years of backtesting and forward testing, I found that the best risk-to-reward ratio is something between 3 to 5R, and the optimal win rate is about 50 to 60%. This gives you a decent win rate while still allowing you to win reasonably big trades. And guess what? This dramatically improves your psychology. You won't be constantly doubting yourself or your strategy because of an extreme low win rate. You'll stop chasing life-changing trades, and the fear of missing out will start to fade. Here's one extra tip for handling the FOMO. Whenever I feel a FOMO creeping in, I ask myself one simple question. This one question has completely changed my trading psychology. Since I started using it, I've stopped taking impulsive trades, I don't regret missed opportunities, and I can patiently wait for the next trade. This question is this the last trade I will ever take in my life? This instantly puts things into perspective. No matter how good or bad a trade is, it will never be the last one. There will be always another trade and another and another. Once you truly internalize this, FOMO disappears. You realize that trading isn't about one single trade. It's about consistently executing your strategy. So if you miss a trade, it's not the end of the world. Now let's move to the rule number 3. What if I told you that you're overtrading not because you're greedy or trying to make more money? The real reason is something that you have never thought about. Once you understand this and apply it to your trading plan, you will never ever overtrade again. Just mark my words. Most traders set a daily loss limit for themselves. They tell themselves, if I take more than 2 losing trades, I will stop trading for the day. But here's the problem. They have no idea of how many trades they should actually take. That's why they keep overtrading, hitting deep drawdowns, and giving back all of their profits if they make any, even when they have a winning day. After years of testing, I've developed a rule of thumb for exactly how many trades you should take. I've broken down into 3 categories. For scalpers, you should take maximum 1 to 2 trades per one session. Whether you're trading Asia, London, or New York, just 1 to 2 trades. For the day traders, maximum 1 to 2 trades per day. For the swing traders, maximum 1 to 2 trades per week. You have to understand, just like in life, the number of opportunities that you are going to take in trading are limited within a specific time frame. So all of that good, but here's the key. This only works if you trade a fully mechanical, rule-based strategy. Think about the OP investing methods. It's a day trading strategy, and most days the price will follow one of the 4 main scenarios we have. On rare occasions, like 2 scenarios might play out in one day, but that's uncommon. Logically, you cannot have the breakout trade or manipulation trade at the same time. The price will either break out of the Asian range or it will just manipulate. There is no two things at the same time. That's why you need to know your strategy and understand that you will only get 1 to 2 high quality setups per specific time based on the type of the trader you are. When you truly apply this, you will never ever overtrade again. I promise you. Rule number 4. Why do you take trades that you regret? Did you ever take a trade only to look back and wonder, why the hell did I even take that? It wasn't perfect, it didn't follow your plan, yet somehow you still pulled the trigger. Why does this happen? Why do traders take compulsive trades that they regret later? It all comes down to something called analysis paralysis. On average, people make from 30 to 40,000 decisions per day. Most happen on autopilot, but when your brain reaches decision fatigue, usually after taking 50 to 100 conscious decisions, it starts shutting down. Instead of thinking logically, you start making impulsive choices. That's what happens when you take bad trades. Your brain is tired of making decisions, so it just takes whatever that feels right in the moment. Does it make sense so far? But here's the good thing. You can eliminate decision-making fatigue from your trading. How? By eliminating the decision-making process altogether. So first, you have to trade a fully mechanical, rule-based strategy. We have covered that in the first 3 videos. Second, you have to offload your brain. Write down your trading plan on paper and follow it like it's a checklist. When you remove decision making from your trading process, you stop making impulsive trades. It is that simple. Rule number 5. We're gonna talk about the number 1 bottleneck holding you back. This is where most traders break down, not because they don't have a good system, not because they lack a profitable strategy, but because they don't stick to one strategy for long enough for the edge to play out. So here's the truth, folks. Trading is seasonal. 3 months of the year, your strategy will outperform. You will crush it. 3 months, it will underperform. Any strategy is going to underperform. You will struggle. And the remaining 6 months, moderate wins, moderate losses. And here's the catch. You can't predict which months will be which. That's why consistency is everything. You have to show up every single day, follow your system, and let the probabilities to play out. But before committing to any strategy, backtest it. Make sure that it actually works. Once you do that, stick with that at least for 1 full year. That's how you're going to win on the long run. Rule number 6. Your environment determines your success. Do you want to survive all of the ups and downs of trading? Do you want to stay committed when things get tough? Surround yourself with the right people. This is literally the hands down one of the biggest secrets to trading success. No matter what strategy you trade, find a community of traders using the same method. And most importantly, find a mentor. Trying to figure out everything on your own is like walking from the East Coast to the West Coast on your foot. Maybe you will make it, maybe you will get lost around the way, but either way, it will take you a lifetime. Having a mentor is like taking a plane. You'll get thousand times faster and your chances of success skyrockets. Of course, if you don't give up. So folks, what's your next step? I just gave you the full blueprint, a mechanical edge over the markets and 6 most important psychology rules to win this game. Now it's up to you. If you're ready to master OP investing methods, scale your trading to 6 or even 7 figures in the next 30 days without guessing your trades or staring at charts all day long, I can help you. What you have to do is just to click the link in the description of this video. It will take you to my IG page. Make sure to follow me because this is how I will be able to reply you. And then just direct message me with the word ready on Instagram. And I will give you more info of how I will be able to help you to scale your trading to 6 figures in the next 30 days. So folks, I will be waiting for you on the other side. See you.